The U.S. economy experienced a major economic slowdown in the month of April. Was this just something that's transitory, or is this the start of a trend that could jeopardize market expectations of a soft landing? In this video, we are going to review a wide variety of economic indicators to try to see exactly what happened in April and try to derive some insights about what we can expect going forward. Let's start our analysis by reviewing what's happening in the manufacturing segment of the economy. I want to start with manufacturing because manufacturing is generally a leading sector. In other words, it's a sector that usually starts to move before other sectors start to move, whether that be to the upside or the downside. And what we can see here is that the growth in manufacturing is well below average in almost all of the indicators that were reported in May corresponding to activity in the month of April. In fact, the levels of growth that we see in manufacturing right now are not too far from what we would usually expect to see in a recession. Now, not only is it growing slowly, but it actually decelerated quite sharply during the month of April, which is what is actually of concern here. That deceleration caught economists by surprise because almost every single one of these indicators surprised to the downside. So manufacturing activity seems to be sending a concerning signal about what may have transpired during the month of April, and we'll just have to see going forward if this continues. Now, we did get a very preliminary indication of what might have happened during the month of May when at the beginning of June, the manufacturing purchasing managers indices were published. There's a couple of these. What we saw from this is that manufacturing activity, again, in the month of May appears to have been quite weak and is decelerating. But we'll have to wait to see the rest of the manufacturing numbers that are going to be reported in June corresponding to May to see if this is confirmed. Now, let's take a look at non-manufacturing activity. First and foremost, retail sales really surprised to the downside during the month of April. Massive deceleration, decelerated down to levels that again are usually associated with recessionary conditions. In particular, the retail control group, which is the retail sales statistic that flows into a number of GDP calculations, was extremely weak in the 13th percentile. So that was a real warning bell. And when we look at overall personal consumption expenditures, which was reported towards the end of May, we see here again that personal consumption expenditures, which by the way account for over 60% of US GDP, were in the 22nd percentile, again at a level that's pretty close to what you would expect during a recession. Now let's look at some other non-manufacturing data. Construction spending down to the 29th percentile, in other words, well below average, decelerating and really surprised economists to the downside. Real wholesale sales. Again, this is an indirect indicator of what's happening in the goods sector of the economy. The growth in that sector actually contracted, or the sector actually contracted, and is running at a level in terms of percent rank that is once again usually associated or close to what you would expect to find in a recession, not during an expansion. Non-manufacturing activity is actually sending warning signals just like the manufacturing sector is. So there's a real unanimity and there's a real breadth here of indicators showing that the US economy really slowed down pretty severely during the month of April. Now let's move on to look at some labor market indicators. The labor market is obviously an extremely important segment of economic data to look at for several reasons. First of all, most people derive their income from their jobs. So when the labor market is strong, it means that most people have jobs, and it also generally means that wages are going to be rising and increasing people's incomes, and that's going to help drive the economy. In addition, there's a special reason that we want to pay special attention to the labor market because labor market conditions are part of the Fed's mandate. Part of the Fed's mandate is to maintain full employment. Whenever we see weakness in the labor market, that may suggest that we're going to be getting out of a full employment situation, then the Fed can come in and intervene into the economy. And what we see here is, again, almost in every single case, labor market indicators decelerated during the month of April. Now, even though there was strong deceleration in almost every single labor market indicator, most of these indicators are not yet at rates or at levels in terms of their percent ranks that are at all associated with what the types of things that we would see during a recession. However, we did see some deceleration, and we're going to need to track that. Now, in terms of the labor market, we already have a good bit of data of what happened during the month of May. It was just reported last Friday, and there we got some contradictory signals. We got a pretty strong report in terms of non-farm payrolls. However, there's some questions surrounding the quality of that particular data, at least this month. And then we got an extremely weak reading in terms of the data that was reported as part of the household survey. For example, unemployment rate actually went up significantly, and the participation rate actually went down. We got some contrary signals a little bit as far as what happened during the month of May, but generally it confirms the idea that the U.S. economy has been decelerating in the last couple of months since March. Now, let's look at some indicators of housing market activity. And I really want to focus on these indicators because, historically speaking, the housing market has played a disproportionate role in the contraction of economic activity that occurs during a recession. It's also tended to be a leading indicator of recession. What's going on in housing is something we want to pay close attention to. And what we see here is in this column where we have percent ranks, with only one exception, housing market activity is running at rates that are well below average and fairly near levels that we generally only see during a recession. So the fact that housing market activity is generally contracting and that it's running at very low rates, that it's surprising to the downside, this is something to be genuinely concerned about. Now, it's true that this is somewhat logical in the sense that interest rates have risen a lot, so you would expect that housing market activity would fall because it's very sensitive to interest rates. The question here is if we're going to continue to see a deceleration in housing market activity going forward. We'll just have to wait and see. But one of the things that we know about the effect of interest rates on the economy is that they tend to operate with a lag, and sometimes a very major lag. Some studies have suggested that the lags are 2 to 3 years in length. So we may not have seen the end of weakness in the housing market, even if it's the case that interest rates have peaked during this cycle. Now let's take a look at consumer sentiment right now. Consumer sentiment is extremely depressed. Just look at these percent ranks, 14.8%, current conditions, 5.4%. It's pretty bad out there in terms of how people are feeling about the economy. Now, consumer sentiment indicators have a really mixed history, a mixed track record in terms of how well they predict economic conditions going forward. Sometimes they've been predictive, sometimes they haven't been at all, and they've been more of a concurrent or a lagging indicator. But the one thing that I want you to take away from this slide today, and this section of my analysis today, is that this pessimism that we see in the data right now is pessimism that we're seeing despite the fact that the economy is doing really well. We have really low unemployment, and in general, the economy is doing pretty well by most objective measures. Now, what would actually happen if something goes bad in the economy? If all of a sudden unemployment were to rise and people were to start fearing about their jobs? There's a situation that you could have some big behavioral impacts, because if consumers are already feeling very wary about the economy and they're feeling sort of wary about their future, they may engage in some pretty severe behavioral changes once the economy actually turns for worse. Now, what kind of behavioral changes am I talking about? And particularly if consumers start engaging in what's called precautionary savings. In other words, if people start spending a lower proportions of their income and spending less on credit. If consumers did that sort of in a pretty sudden fashion where they went from spending pretty freely as they have been recently with very low savings rates and very high rates of usage of consumer credits. If that were to actually turn around quickly, that could absolutely trigger a recession. So that's something we need to really watch carefully, not because consumer sentiment necessarily has to have a predictive element to it, but what I think that consumer sentiment does is tell us that the economy is vulnerable to a severe turnaround if there's some sort of a catalyst that would cause a downturn in the economy. And if there's that downturn in the economy, consumer behavior could actually really turn sour and consumers could stop spending. So let's summarize what we've seen until now and draw some conclusions about what we should be looking for going forward. The first and the most important thing that you need to get from this video is that the U.S. economy accelerated very sharply during the month of April. In fact, the economy accelerated so much that it's probably a toss-up whether the economy may have actually contracted during April. But even if it didn't contract, certainly overall economic growth was pretty near zero during the month of April. And that is obviously a level that is pretty close to what you would expect during a recession. However, it's just 1 month, so we can't make too much of 1 month, but such a fast deceleration is definitely something to be wary of. And the other thing that we should see here is that this isn't just some sort of statistical effect, because there was a tremendous breadth of indicators that are indicating this slowdown. So it was something that was real. We just have to see if it's actually going to continue going forward. Now, so far in May, or the data in May that's been reported during the early part of June, are looking pretty mixed. The manufacturing data in general were pretty bad. However, the non-manufacturing PMIs actually showed some strength. In addition, we also got the labor market report from the BLS. And again, there were some mixed signals there, but in general, that report was supportive of the idea that the economy is slowing. It would only take 1 or 2 more months of data like we got in April to really start raising some eyebrows and getting people to really worry about what's happening in the economy. Right now, what we have to understand is that financial markets are overwhelmingly betting on a soft landing for the U.S. economy. What does a soft landing mean? It means that inflation, which was high, is going to come down, and it'll come down to the Fed's 2% target. And at the same time, economic growth is going to decelerate down to an average to below average pace without actually falling into recession. Now, if we start decelerating well below average and start getting growth that starts coming close to recessionary levels, what we had in April, then people are going to start wondering, hey, maybe we're not going to have a soft landing. We might have a hard landing where we have a recession. So I think if we just get 1 or 2 more months of this type of data like we got in April, people are going to really start getting concerned about that. However, so far, we only have this data for April. The economy had been extremely strong during the first quarter of the year. If we look at things in perspective, this was just 1 month versus 3 prior months that had been very strong. So we're just going to have to see if in May we get confirmation of this trend of weakness that we saw in April, or if April may have just been a little bit of a fluke. Now, the one thing that I think that we can take away here is that as a result of what happened in April, economic risks are rising. In other words, this risk of a hard landing, which really wasn't even a risk up until about a month ago, they didn't seem like much of a risk of a hard landing. In fact, the big problem that we had in the economy, quite frankly, during the first 3 months of the year was that it seemed like the economy was growing too fast. And this was posing inflationary dangers for the economy. All of a sudden, we go from a situation where the economy was growing too fast to a situation where the economy slowed down really dramatically in April. So this raises risks in the economy that we could slip into a recession when that wasn't even anywhere on the horizon. The other thing that's risky here is that if the economy slows down really quickly, the Fed may have its hands tied in terms of being able to intervene, because we have to remember that inflation is still extremely high. And it's going to be very tough for the Fed to preemptively intervene in the economy to head off a potential recession. The Fed really needs to honor its word and get inflation down to its 2% target. So if the economy slows very quickly, I think the Fed is going to be very slow to react because the Fed doesn't want to lose credibility. If the Fed, for example, were to react hastily to slow economic data like we had in April, and then we get a pickup in inflation, the Fed's reputation would be shot, and they know that. So they need to be very cautious about when and by how much they eventually cut interest rates. And right now, I think they're going to really just have to be very cautious and take their time. And that poses a danger to the economy because if they have to be conservative about not being preemptive, that means that they won't be able to be preemptive as they see the economy slow down really quickly. So this pretty much wraps up my video for today. Please subscribe to this channel. I'm going to be posting a series of videos in the next week that are extremely important, that are extremely interesting. The reason I'm actually posting all these videos right now is that I find that right at this moment is a key moment. There's a lot of things going on in the economy, a lot of things going on in the world, and I think it's important for all of my clients and all of my investors to hear from me frequently and personally like this so that I can try to transmit my ideas about what I'm thinking. So I really encourage you to subscribe to this channel because I'm going to be communicating to you through this media quite frequently during the next few weeks and months. Thank you.